Now we'll be learning about the accounting equation. The accounting equation is a very simple one. It states that the amount of assets the business owns is equal to the capital plus the liability the business owes. This is also known as assets is equals to owner's equity plus liability, because we know that the capital is the owner's equity, because that is sourced from the owner. This accounting equation is also known as a balance sheet equation, because as we saw, a balance sheet comprises of assets, capitals and liabilities, and this is exactly what our equation shows. But let's understand why this equation makes sense. This equation makes sense because, let's look at this. What are our assets? Assets are all the resources the business owns. So this shows where all the finance the business has been used. Whereas our liabilities and the capital shows where has all this finance been sourced from. So we are seeing where the finance is being sourced from and where this finance is being used or stored. So obviously they both need to be equal. Now to understand this equation, let's look at the working of the first month of Jim's business, so that we can understand that this equation makes sense and is true. So over here I have three columns: assets, owner's equity and liabilities. So let's look at January the 1st, when Jim decides to start the business, and to start the business he allocates cash of $50,000 and his premises worth $30,000. So these both are added to the assets, as we can see. At the same time we can see that the owner's equity, which is the capital area, has $80,000 over there, because that is the amount the owner, which is Jim, has invested. Now we can see that on 2nd January the business decides to buy a new machinery worth $20,000. Where is this machinery? Where is the finance for this machinery being sourced from? From the cash. We use, out of the $50,000 cash, we use $20,000 to buy the machinery. So we have $20,000 worth of machinery in asset, and capital is not affected, as we can see. But over here also you can see that the total assets are worth $80,000 and capital is also worth $80,000. The accounting equation makes sense, as we have zero liabilities at the moment. Now on 2nd January, Jim decides to buy some inventory from a supplier, but he does not pay him in cash as of now. Just buys $3,000 worth of inventory from the supplier, and in a future date will pay the supplier. So a supplier becomes a liability. So as we can see, the liability column has $3,000 over there, which is our trade payables, because we need to pay the supplier. At the same time, our assets column is increased by $3,000 with inventory worth $3,000. So we can see our assets are worth $83,000. At the same time, capital plus liabilities are also worth $83,000 in total. Sorry, I'll change the dates. They are incorrect. This is January the 3rd, and let's make this January 7th. Great. So on January 7th we can see Jim decided to sell some of the inventory to one of its clients. Jim sold $2,000 worth of inventory to one of his clients. So what happens is our inventory column decreases by $2,000 to $1,000. So the assets has decreased, the inventory asset has decreased from $3,000 to $1,000. At the same time, now we have a trade receivable, because our client will at some point will have to pay us back. So that becomes our trade receivables, which will also be added in the assets, because that is an expected income. As we can see, as of now, our assets are total $83,000. At the same time, capital plus liabilities are also $83,000. Similarly, as the functioning of the business continues, this same equation will hold true, where our assets is equal to capitals plus liability. Thank you.